Every April, millions of retired Americans sit down, fill out their tax return, and write a check to the IRS. And most of them have no idea that a significant portion of what they just paid, they didn't legally owe. Not because of a loophole, not because of a technicality, but because the tax code contains specific provisions for people over 65, for retirement income, for Social Security, for capital gains, and for estates. And the vast majority of retirees either don't know those provisions exist or don't know how to apply them correctly. The average American household pays over $14,000 a year in federal taxes. For a retired household living on Social Security, a pension, and investment income, the number is lower. But the percentage of that bill that is avoidable or reducible is far higher than most people realize. Today, I'm walking through 5 specific categories of taxes that retirees are overpaying right now. For each one, I'll tell you what the law actually says, how much money is realistically at stake, and exactly what you need to. My name is Lucien Vane, and I've spent years studying the intersection of retirement income and tax law. Specifically, how the tax code treats people over 65 differently from working-age taxpayers, and why most retirees never take advantage of those differences. What I'm going to share today is not aggressive tax strategy. It's not offshore accounts or complex trusts. It's the straightforward, legal provisions that are written into the tax code specifically for people in retirement, that most tax preparers either don't ask about or don't explain clearly. Let's go through all 5. Tax number 1 is the one that surprises the most people because it involves money that millions of retirees assume is tax-free. Social Security income is taxable. But here's what most people don't know. It is not always taxable. It is not fully taxable for most people, and there are specific legal strategies to reduce how much of it gets taxed. And almost nobody explains this clearly. Here's how the IRS calculates it. They use something called combined income, which is your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefit. Based on that combined income number, they determine what percentage of your Social Security is subject to federal income tax. If your combined income is below $25,000 as a single filer or below $32,000 as a married couple, none of your Social Security is federally taxable. 0. If your combined income falls between $25,000 and $34,000 single, or $32,000 and $44,000 married, up to 50% of your benefit is taxable. Above those thresholds, up to 85% of your Social Security can be taxed. Now, here's where the real money is, and where most retirees leave it on the table. The percentage of Social Security that gets taxed is determined by your combined income, which means if you can legally reduce your combined income, you reduce the percentage of Social Security that's taxable, sometimes dramatically. How do you reduce combined income in retirement? 3 legal strategies that most retirees don't use. Strategy 1. Roth conversions. Money withdrawn from a Roth IRA is not counted in combined income. If you converted traditional IRA funds to a Roth during lower income years, or if you do it strategically now, future withdrawals won't push your combined income higher. Strategy 2. Qualified charitable distributions. If you're 70 and a half or older and you have a traditional IRA, you can donate up to $105,000 per year directly from your IRA to a qualifying charity. That amount counts toward your required minimum distribution, but it never shows up in your adjusted gross income, which means it doesn't push up your combined income, which means it doesn't increase the percentage of your Social Security that gets taxed. Strategy 3. Timing your income. If you have flexibility in when you take IRA withdrawals, when you sell investments, or when you take capital gains, you can plan withdrawals in years when your other income is lower, keeping your combined income in a lower tier and reducing how much of your Social Security gets taxed. Now here's the state piece that most people completely miss. The federal government taxes Social Security under the rules I just described. But your state may also tax it, or may not. And the state-level picture is dramatically better for most retirees. As of 2025, the majority of states do not tax Social Security income at all. States including Florida, Texas, Nevada, Washington, Tennessee, Arizona, Georgia, and many others exempt Social Security entirely from state income tax. The states that still tax Social Security include Minnesota, Vermont, Connecticut, Montana, New Mexico, Rhode Island, Utah, West Virginia, Missouri, Nebraska, Kansas, Colorado, and North Dakota, though several of these have partial exemptions based on income. If you live in a state that taxes Social Security and you have flexibility in where you live in retirement, the state-level tax on Social Security is a real factor worth calculating. Tax number 2 is the one with the most variation and the most opportunity, depending on where you live. Beyond Social Security, many states also have specific exemptions or exclusions for other types of retirement income: pension income, IRA withdrawals, 401k distributions, and investment income. And the range from state to state is enormous. Let me give you the landscape clearly. 9 states have no state income tax at all: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. If you live in any of these states, you pay 0 state income tax on any of your retirement income, period. Beyond those 9, many other states offer full or partial exemptions specifically for retirement income. Illinois exempts all retirement income, Social Security, pensions, IRA distributions, from state income tax entirely. Mississippi does the same. Pennsylvania exempts most retirement income, including pensions and IRA withdrawals, for people who have reached retirement age. Alabama exempts most pension income. Hawaii exempts most pension income for government and military retirees. Now here's where it gets important for people who are not in those states. Even in states that do tax retirement income, many offer partial exemptions based on age or income. Georgia exempts up to $65,000 per person of retirement income for taxpayers 65 and older. That's $130,000 for a married couple. South Carolina exempts up to $15,000 of retirement income. Virginia exempts up to $12,000 for taxpayers 65 and older. The action step here is very specific. Pull up last year's state tax return. Look at the line where you reported retirement income. Then search your state name, Retirement Income Exemption, and compare what you reported to what the state law actually allows you to exclude. You may find you've been reporting and paying tax on income that your state exempts. There's one more piece of the state income tax picture that most retirees miss entirely: the extra standard deduction for people over 65. At the federal level, taxpayers who are 65 or older receive an additional standard deduction on top of the regular standard deduction. For 2025, that additional amount is $1,950 for a single filer and $1,550 per qualifying spouse for married filers, meaning a married couple where both spouses are 65 or older gets an additional $3,100 on top of the regular standard deduction automatically. That additional deduction reduces your taxable income, which reduces your tax bill, which means if your tax preparer is not specifically noting your age and applying this, ask them directly. And if you're filing your own return, make sure the software is applying it. It's automatic if you enter your birth date correctly, but it's worth verifying. Tax number 3 is the one that catches the most comfortable middle-class retirees by surprise, and also the one with the biggest potential upside. Because for many retirees, the correct capital gains rate is 0. Not reduced, not discounted, 0. Here's how long-term capital gains taxation works for retirees. Long-term capital gains, meaning gains on investments held for more than 1 year, are taxed at preferential rates, 0%, 15%, or 20% depending on your taxable income. Not your gross income, your taxable income, after deductions. For 2025, a single filer with taxable income up to $47,025 pays 0% in federal capital gains tax on long-term gains. A married couple filing jointly pays 0% up to $94,050 in taxable income. Here's why that matters so much for retirees specifically. A retired couple whose income comes primarily from Social Security and modest IRA withdrawals, and who keeps their total taxable income below that $94,050 threshold, can sell appreciated investments, receive dividends, and realize capital gains without paying a single dollar in federal capital gains tax. This is one of the most powerful and most underused windows in the entire tax code. But it requires knowing where your income is landing before you sell, not after. Let me give you a concrete example. A retired couple has $40,000 in Social Security income. After the standard deduction and the over 65 additional deduction, their taxable income is well below the $94,050 threshold. They have a brokerage account with $80,000 in appreciated stock they've held for years. If they sell that stock and realize $50,000 in long-term capital gains, and their total taxable income stays below $94,050, they owe $0 in federal capital gains tax on that $50,000 gain. The same $50,000 gain for a working-age taxpayer in a higher bracket would be taxed at 15%, a $7,500 tax bill. For this retired couple, it's $0. The key word in all of this is planning. You need to know your income before you sell, not after. If you're going to take IRA withdrawals that year, if you're going to receive a large pension payment, if you're going to have other income, all of that affects where your taxable income lands and whether the 0% rate applies. There's one more capital gains situation that trips up retirees and costs many of them far more than it should. And that's the sale of a home. If you sell your primary residence, the IRS allows you to exclude up to $250,000 of capital gains from the sale if you're a single filer, or up to $500,000 if you're married filing jointly, as long as you've lived in the home as your primary residence for at least 2 of the last 5 years. This is the home sale exclusion, and for most retirees selling a home they've owned for decades, it means the entire gain on the sale is completely tax-free. But here's the catch. If your home has appreciated significantly, and many homes across America have more than doubled in the last decade, gains above those exclusion amounts are taxable. If you're planning to sell a home with very large appreciation, run the numbers before you close. The difference between selling in one tax year versus another, or filing jointly versus separately, can be a 5-figure tax difference.
Tax number 4 is the one that creates the most anxiety, and also the one where most people's anxiety is focused on the wrong thing. Estate tax, inheritance tax, the death tax, as it's sometimes called. Most retirees worry about it more than they need to at the federal level, and far less than they should at the state level. Here's the federal picture first. For 2025, the federal estate tax exemption is $13.61 million per individual, meaning an individual can pass up to $13.61 million to their heirs without any federal estate tax. A married couple can effectively pass up to $27.22 million. If your total estate, everything you own, including your home, retirement accounts, investment accounts, life insurance, and other assets, is below those thresholds, your heirs owe 0 federal estate tax. For the overwhelming majority of American retirees, including people who own a paid-off home, have retirement savings, and have modest investment accounts, the federal estate tax simply does not apply. But here is the piece that almost nobody discusses, and where real money is at stake for many more retirees. 12 states, plus the District of Columbia, have their own separate estate tax, with exemption thresholds far below the federal level. Oregon's estate tax kicks in at $1 million, Massachusetts at $2 million, Washington State at $2.193 million, Maryland at $5 million, and 6 states, Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania, have an inheritance tax, which is paid not by the estate, but by the people who receive the inheritance, and which applies based on the relationship of the heir to the deceased. This matters for retirees who own a paid-off home in an expensive real estate market. A home worth $1.2 million in Oregon, combined with retirement savings and life insurance, can push an estate above that state's $1 million threshold. And suddenly, an estate that owes 0 federal tax owes a meaningful state tax. The 6 inheritance tax states are the other trap. In Pennsylvania, for example, inheritances passed to children are taxed at 4.5%, to siblings at 12%, to other heirs at 15%. Only inheritances passed to a surviving spouse are completely exempt. What can you do about this? 3 things. First, if you live in a state with a low estate tax threshold, talk to an estate planning attorney about strategies to reduce the taxable estate, including gifting strategies, irrevocable trusts, or charitable giving. Second, if you live in one of the 6 inheritance tax states, make sure your beneficiaries know what to expect, because the tax is their liability, not the estate's, and it can come as a complete shock. Third, consider whether your state of residence in retirement is the right one from an estate planning perspective. Moving from a state with an estate tax to a state without one, like Florida, Texas, or Nevada, can preserve a meaningful amount of wealth for your heirs. Tax number 5 is the one I cover most extensively in other videos, and I'm going to give you a compressed but complete version here, because no list of taxes retirees should stop overpaying is complete without it. Property tax is the single largest recurring bill most homeowners pay on a home they already own. The national average is over $4,800 a year. For a retiree who stays in their home another 20 years, that's nearly $100,000. And every state in the country offers exemptions, reductions, freezes, and deferrals specifically for homeowners over 65, most of which go unclaimed because no one tells you to apply. Let me give you the 5 most important ones quickly. The homestead exemption. Every state offers a homestead exemption on your primary residence that takes a chunk of assessed value off the books before the county calculates your bill. In Florida, that's $50,000. In Texas, it's $100,000 on the school portion. File a one-page form once, and in most states, it stays on file forever. If you don't have this filed, call your county appraisal office tomorrow. The senior exemption. Most states that offer a homestead also offer an additional exemption that activates when you turn 65. It's a separate form. The county will never automatically send it to you. In Florida, the senior exemption can be another $50,000 on top of the basic homestead. In Texas, an additional $10,000 on the school portion. In New York, up to 50% off assessed value for qualifying seniors. Different states, same principle. File the form, get the reduction. The Senior Assessment Freeze. This is the single most valuable property tax tool for retirees in appreciating markets. When you file the freeze application, the county locks in your home's assessed value at whatever it was the year you applied. Your home can double in value. Your tax bill stays at the frozen number. In Texas, the school district bill is frozen at the actual dollar amount the year you turn 65. In Illinois, the equalized assessed value is frozen. In New Jersey, the senior freeze refunds every dollar of increase above your first qualifying year. One form. Permanent protection from appreciation-driven tax increases. The circuit breaker credit. If your property tax bill exceeds a certain percentage of your household income, usually 3 to 6%, many states will refund you the excess. This is filed as part of your state income tax return and can mean hundreds of dollars back per year for retirees on fixed incomes. The property tax deferral. If you're over 62 or 65, depending on the state, you can apply to defer your property tax payments entirely. The state pays on your behalf. The amount accumulates as a lien on your home, repaid only when you sell or the home passes to heirs. For homeowners who are house-rich and cash-poor, this is life-changing. Here's the thread that connects all 5 taxes we've covered today. Every single one of them, Social Security taxation, state income tax, capital gains, estate tax, property tax, is affected by one decision more than any other single factor: where you live. A retired couple who moves from a high-tax state like New York, New Jersey, or Illinois to a state like Florida, Texas, or Nevada can eliminate state income tax on their Social Security, eliminate state income tax on their pension and IRA withdrawals, eliminate state estate tax on their estate, and access some of the strongest property tax freeze programs in the country, all in a single move. That's not financial advice. That's the reality of how differently the tax code treats the same dollar of retirement income depending on where you live. Here is your complete action list. 1. Calculate your combined income and check which Social Security tax tier you're in. If you're close to a lower tier, talk to a financial advisor about strategies to reduce combined income. 2.
Pull up your state's retirement income exemption rules and compare them to what you reported last year. You may find you overpaid. 3. Verify that your over 65 standard deduction is being applied on your federal return. 4. Before you sell any appreciated investment, calculate your taxable income for that year and determine whether you qualify for the 0% capital gains rate. 5. If your estate plus your home's value puts you near your state's estate tax threshold, talk to an estate attorney. 6. Call your county assessor and confirm that every available property tax exemption is filed for your home. None of these are complicated moves. Every single one of them is a phone call, a form, or a calculation. The only thing standing between most retirees and paying less in taxes is knowing which questions to ask. Now you know. If this was useful, hit subscribe. I cover retirement financial rights and tax strategies like this every single week. The information most people only find out about years after they needed it. Share this with every retiree you know who is still filing their taxes the same way they did when they were working. The tax code in retirement is different, and understanding that difference is worth real money. I'll see you in the next one.